Listen, if you're thinking about buying real estate in 2026, you need to stop right now and pay very close attention to what I'm about to tell you because there are 5 states in America where the housing market is on the verge of a significant collapse. And if you buy property in the wrong location, you could lose tens of thousands or even hundreds of thousands of dollars in equity. And I'm not being dramatic here. I'm looking at the data, the forecasts, the economic indicators, and they're all pointing to the same conclusion. Certain markets that went absolutely insane during the pandemic are now facing a brutal correction that's going to wipe out wealth for people who bought at the peak. Now, before I reveal these 5 states, I need you to do something for me. Hit that subscribe button right now and smash the like button because the information I'm about to share with you could literally save you from making the biggest financial mistake of your life. This isn't just general advice. This is based on real data from Realtor.com, Zillow, Redfin, and economic forecasts from the top analysts in the country. And if you value your financial future, you need to know which markets to avoid. Here's what's happening right now in 2026. We're seeing the aftermath of one of the craziest real estate booms in American history. During the pandemic, people were buying houses sight unseen. They were offering 20, 30, sometimes 40% over asking price. They were waiving inspections. They were getting into bidding wars, and everyone thought real estate only goes up. Well, guess what? It doesn't. And now we're seeing the correction. Home prices in certain markets have already fallen 10, 15, even 20% from their peak, and they're not done falling. And here's the thing that most people don't understand. Not all housing markets are created equal. While some markets are going to remain stable or even grow in 2026, there are specific states and specific metros within those states that are facing a perfect storm of declining prices, rising inventory, increasing insurance costs, climate risks, and demographic shifts that are going to absolutely devastate property values. And if you're not paying attention to these trends, you're going to get caught holding a property that's worth significantly less than what you paid for it. So here's what we're going to do. I'm going to walk you through the 5 states you need to avoid in 2026. I'm going to explain exactly why each market is in trouble. I'm going to show you the data, the numbers, the forecasts, and most importantly, I'm going to tell you what to do instead, because this isn't just about avoiding bad investments. It's about positioning yourself to take advantage of the opportunities that exist in other markets. All right. Well, Florida. Let's start with the big one, Florida. And I know this is going to upset a lot of people because Florida has been the darling of real estate investors for the last 5 years. Everyone was moving there during the pandemic. Remote workers were flooding in from New York, California, New Jersey. Texas companies were relocating. There was no state income tax. The weather was great. It seemed like the perfect place. Well, the party's over, and Florida is now facing one of the worst housing corrections in the entire country. According to the latest forecasts from Realtor.com, 4 of the top 10 markets expected to see the biggest price declines in 2026 are in Florida. We're talking about Cape Coral, which is projected to see prices fall 10.2%, Northport, Sarasota, Bradenton down 8.9%, Deltona, Daytona Beach down 3.6%, and Tampa St. Petersburg down 3.6%. And these aren't small markets. These are major metropolitan areas with hundreds of thousands of people. Now let me explain why Florida is in such trouble. First, insurance costs have absolutely exploded. Cape Coral has the 3rd highest insurance premium to market value ratio in the entire nation at 2.2%. That means if you buy a $350,000 house, you're paying $7,700 a year just in homeowners insurance. That's more than $640 a month just for insurance, on top of your mortgage, on top of your property taxes, on top of your HOA fees, if you're in a condo, this is making homeownership unaffordable for huge numbers of people. Second, climate risk is real. Florida is getting hammered by hurricanes. We saw Hurricane Ian devastate parts of southwest Florida. We're seeing flooding, we're seeing storm surge, and insurance companies are responding by either pulling out of the state completely or jacking up rates to levels that are unsustainable. And this isn't going to get better. If anything, it's going to get worse as climate change intensifies. Third, the demographic shift that drove Florida's boom is reversing. During the pandemic, people could work remotely from anywhere, so they moved to Florida for the lifestyle and the tax benefits. But now companies are calling people back to the office, and a lot of these remote workers are realizing that living in Florida when your job is in New York or San Francisco doesn't actually work, so they're selling and moving back, and that's flooding the market with inventory. Fourth, the condo market in Florida is in absolute crisis. After the Surfside collapse in 2021, Florida passed new building safety regulations that require condo associations to do massive structural assessments and repairs, and these costs are being passed on to condo owners in the form of special assessments that can run $50,000, $100,000, even $200,000 per unit. People can't afford these assessments, so they're trying to sell, but nobody wants to buy a condo with a massive special assessment hanging over it. So prices are cratering. Let me give you some specific numbers. In Cape Coral, home prices have already dropped more than 13% from their pandemic peak. The Wall Street Journal recently called Cape Coral the worst housing market in America, with almost 8% of homeowners owing more on their mortgages than their homes are worth. That's underwater. That's a disaster. And according to foreclosures data, Cape Coral has one of the highest foreclosure rates among major metros in the country. Now, here's what's really concerning. This isn't just a short-term blip. The forecasts show that Florida markets are expected to continue declining through at least mid-2026, maybe longer. Karen Borelli, president of the Royal Palm Coast Realtor Association, says that Cape Coral prices have already fallen 5 to 10% in recent years, and she expects the correction to continue. Kara Amir, a Florida real estate expert, points out that while Florida has no state income tax, the savings are being completely wiped out by rising insurance, HOA fees, and property taxes. So here's the bottom line on Florida. Unless you're getting an absolute steal, unless you're buying significantly below market value with cash, so you're not worried about being underwater on a mortgage, unless you fully understand and can afford the insurance and climate risks, stay away from Florida real estate in 2026, especially in coastal markets, especially in Southwest Florida, and definitely stay away from condos unless you've done extensive due diligence on the building's structural condition and financial reserves. Now let's talk about California. And I know what you're thinking. California real estate is always expensive. It never goes down. Wrong. California is home to 3 of the top 10 markets expected to see price declines in 2026. We're talking about Stockton, which is projected to see prices fall 4.1%, Sacramento down 3.3%, and even the San Francisco Bay Area down 2.5%. Now let me explain what's happening in California. First, the state experienced a massive exodus during the pandemic. People and companies were fleeing California for Texas, Florida, Arizona, Nevada, anywhere with lower taxes and lower cost of living. And while some of that migration has slowed, it hasn't reversed. California is still losing population, especially middle-class families who can't afford to live there anymore. Second, California real estate prices got so inflated during the pandemic that they're now completely disconnected from local incomes. The typical California household now spends more than 35% of their income just on housing costs. That's above the historical average. That's unsustainable. And as mortgage rates have stayed elevated around 6 to 7%, Fewer and fewer people can afford to buy, so demand has cratered. Third, California has unique challenges with taxes and regulations that make it expensive to own property. You've got high property taxes. You've got Mello-Roos fees in many communities. You've got HOA fees. You've got high insurance costs, especially in fire-prone areas. All of this adds up to a total cost of ownership that's pricing people out of the market. Let me zoom in on specific markets. Stockton in the Central Valley is particularly vulnerable. It saw massive price appreciation during the pandemic as Bay Area residents looked for more affordable options. But now that appreciation is reversing, Stockton's forecast shows a 4.1% decline, which is the third largest drop. And this is a market where the median home price is still relatively low compared to coastal California, around $400,000 to $450,000. So when you're seeing declines in these more affordable inland markets, that tells you the correction is deep. Prices are expected to drop 3.3% in 2026, according to Realtor. The capital city benefited from spillover demand from the Bay Area during the pandemic, but now with higher inventory levels and reduced buyer demand, prices are softening. Sacramento currently has about 5 months of inventory, which is moving toward a buyer's market. Even the San Francisco Bay Area, which has traditionally been one of the most resilient markets in the country, is expected to see a 2.5% decline. Now, that might not sound like a lot, but when you're talking about a market where the median home price is close to $1.5 million, a 2.5% decline is $37,500. That's real money, and Zillow's forecast actually shows that San Francisco could see even larger declines through late 2026. Here's what's driving the Bay Area correction. The tech industry, which is the backbone of the region's economy, has gone through massive layoffs. Companies are cutting costs. They're requiring return to office, which reduces demand for housing in expensive urban areas. And at the same time, the work-from-home phenomenon has allowed some tech workers to relocate to cheaper states while keeping their California salaries of high-income buyers. The bottom line on California, if you're looking at real estate in the Golden State, be very careful about Central Valley markets like Stockton, Sacramento, Fresno, and Bakersfield. These are the areas that are most vulnerable to price declines for Centra. And even in traditionally strong markets like the Bay Area and San Diego, don't expect appreciation in 2026. Expect flat to slightly declining prices. And if you're buying, make sure you're getting a good deal relative to rental prices. Make sure the numbers actually work, because you can't count on appreciation to bail you out. I know. Now let's move to Texas, and specifically Austin, which is experiencing one of the most dramatic housing corrections in the entire country. Austin home prices peaked at about $559,000 in the summer of 2022, and as of late 2025, they've fallen to around $428,000 to $440,000, depending on the source. That's a decline of 18 to 20% from the peak, and according to multiple forecasts, prices still have further to fall in 2026. Let me explain what happened in Austin. During the pandemic, Austin became the poster child for the tech exodus from California. Tesla moved its headquarters there. Oracle moved there. Apple expanded its presence. Meta and Google opened offices. The city was booming. Everyone wanted to live there, and prices went absolutely parabolic. In some neighborhoods, prices doubled in just 2 years. It was insane. But here's what nobody talked about. That level of appreciation was completely unsustainable. Austin home prices got so far ahead of local incomes that the average household was spending 35% or more of their income on housing. And when mortgage rates spiked from 3% to 7%, the monthly payment on a median-priced home in Austin became unaffordable for the vast majority of residents. So what happened? Demand collapsed, inventory exploded, Austin now has about 5 months of inventory, which is well above the balanced market level. Homes are sitting on the market for 50 to 60 days instead of getting multiple offers in the first weekend, and sellers are having to cut prices to attract buyers. According to Zillow's forecast, Austin prices are expected to decline further in 2026. Some analysts predict another 1 to 3% drop before the market finally bottoms out. And here's the concerning part. Even after all these price declines, Austin still isn't affordable by historical standards. The affordability ratio is still above the long-term average, which suggests that prices might need to fall even more to reach true equilibrium, no? Now, it's not just Austin. Other Texas markets, San Antonio and other Texas cities, are expected to see flat to slightly declining prices. In 2026, Dallas and Houston are more stable, but they're not seeing the growth they had during the pandemic. You know, here's the bottom line on Texas. If you're looking at Austin, understand that you're buying into a market that's still correcting. Prices have already fallen 20%, and they could fall further if you're buying as a long-term hold. If you believe in Austin's fundamentals, if you're getting a good deal, it might work out, but don't expect appreciation in 2026. Expect further decline or at best stabilization. And if you're buying as a short-term flip or you're counting on appreciation, stay away. Now let's talk about North Carolina, specifically the Raleigh metro area, which is expected to see home prices decline 3.7% in 2026, according to Realtor. Now, this one might surprise people because Raleigh has been one of the hot markets for the last decade. It's been growing. Tech companies have been moving there. It's got good weather, good quality of life, relatively affordable compared to coastal cities. But here's what's happening. Raleigh experienced such rapid price appreciation during the pandemic that affordability has become a major issue. Home prices have far outpaced income growth. And now with mortgage rates elevated, a lot of potential buyers are priced out, according to the News and Observer. Home price growth has significantly exceeded income growth in recent years, creating an affordability gap. The correction in Raleigh isn't as severe as what we're seeing in Florida or Austin, but it's happening. Inventory is increasing. Homes are taking longer to sell, and sellers are having to adjust their expectations. And here's the thing. When a market that's been hot for years starts to cool, that can create a psychological shift where buyers pull back waiting for lower prices, and that can accelerate the decline. The bottom line on North Carolina, Raleigh is still a fundamentally strong market with good job growth and population growth. But in the short term, you're likely to see flat to declining prices in 2026. If you're buying for the long term and you believe in the market's fundamentals, it could work out. But if you're looking for quick appreciation, look elsewhere. Finally, let's talk about Colorado, specifically the Denver metro area, which is expected to see home prices decline 3.4% in 2026. Now, Denver's situation is a bit different from the other markets because part of the price decline is due to an increase in multifamily housing supply. More apartments and condos are being built, and these typically have lower price points than single-family homes, so they're pulling down the median price. But there are also fundamental affordability issues. In Denver, renting is actually more affordable than buying an entry-level home in the city, which is contributing to declining demand from first-time buyers. And with inventory sitting at about 3.6 months of supply, the market is moving toward balance. Denver also faces some of the same challenges as other Western markets: high prices relative to local incomes, elevated mortgage rates making affordability difficult, and some outmigration as people who moved there during the pandemic are reconsidering. Uh, uh, you know, The bottom line on Colorado, Denver is facing a normalization rather than a collapse. Prices are coming down from unsustainable levels, but the market isn't falling apart. If you're looking at Denver real estate, be realistic about pricing. Don't overpay. And understand that you're probably not going to see significant appreciation in 2026. All right, so now you know the 5 states to avoid: Florida, California, Texas, especially Austin, North Carolina, and Colorado. These are markets that are facing price declines, affordability challenges, and various other risks in 2026. So the question is, what should you do instead? First, if you're in the market to buy real estate, look at the Northeast and Midwest. Markets like Long Island, the Hudson Valley, Northern New Jersey, Connecticut. These are areas where Redfin and Realtor.com predict significant price appreciation. We're talking about potential gains of 10% or more in cities like Syracuse, Toledo, Rochester, Hartford, Baltimore. These markets were undervalued for years. They offer much better affordability than coastal markets, and they're now seeing renewed interest. Second, if you're buying in any market, including the ones I warned you about, be extremely careful about your purchase price. Don't overpay. Don't get emotional. Don't get caught up in bidding wars. In a market where prices are declining or flat, the only way to build wealth is to buy below market value, to get a deal, to buy from a motivated seller. That's how you protect yourself. Third, think like an investor. Even if you're buying a primary residence, run the numbers. What would this property rent for? What's the rent to price ratio? What are the total carrying costs, including insurance, taxes, HOA fees? How does that compare to renting? If the numbers don't work, don't buy. Rent instead and invest your down payment money in the stock market or other assets. Fourth, if you already own property in one of these declining markets, don't panic. Real estate is a long-term game. If you bought before the pandemic boom, you probably still have significant equity even with the recent declines. And if you're not planning to sell in the next few years, these short-term price movements don't really matter. But if you bought at the peak, if you're underwater or close to it, you need to be strategic. You might need to hold on until the market recovers, or you might need to cut your losses and move on. It depends on your situation. Thanks for watching. If you haven't already, hit that subscribe button so you don't miss my future videos where I break down the financial decisions that separate wealthy people from everyone else. Hit the like button if this information was valuable.